On August 12, 1982, Mexico's Finance Minister Jesus Silva Huzog telephoned the United States Treasury and the IMF. Mexico could no longer service its foreign debt. The announcement sent shockwaves through global banking. If Mexico defaulted, so might Brazil, Argentina, and a dozen other countries. The international banking system faced its first systemic sovereign debt crisis. The origins lay in the petrodollar recycling boom of the 1970s. OPEC's oil price increases generated vast surpluses in the hands of oil-producing states, which deposited them in Western banks. Those banks, awash in deposits and under pressure to lend, recycled the capital into Latin American sovereign loans at variable interest rates. Latin American governments borrowed to fund industrialization, infrastructure, and social programs, but also to paper over budget deficits and subsidize politically connected industries. Debt-to-GDP ratios climbed steadily throughout the 1970s. As long as interest rates were low and commodity prices high, the arithmetic worked. Paul Volcker's anti-inflation campaign changed everything. The Federal Reserve raised interest rates to 20% in 1981. Variable rate loans repriced upward. Simultaneously, the global recession cut commodity prices, the primary export earnings of Latin American debtors. Debt service consumed export revenues. The mathematics of solvency reversed overnight. By 1983, 40 countries had rescheduled their debts. The 9 largest US banks had combined loans to Latin America equal to 280% of their capital. A generalized default would have made every major American bank technically insolvent. The debt crisis exposed 3 interlocking failures. First, the loans should never have been made at variable rates to sovereign borrowers whose revenues were commodity-dependent. The matching of floating-rate dollar liabilities against commodity price-sensitive revenues was a structural mismatch that regulators failed to identify. Second, the IMF's initial response, extending bridge loans conditional on austerity, compressed demand in already contracting economies. Fiscal multipliers in crisis conditions meant that each dollar of spending cut reduced GDP by more than $1. The prescribed medicine was contractionary when expansion was needed. Third, the debt overhang itself became an obstacle to recovery. Countries carrying unsustainable debt burdens had no incentive to implement growth reforms. All additional output would flow to foreign creditors rather than to domestic investment. This debt overhang trap was not initially recognized by creditors or the IMF. The 1980s became a lost decade for Latin America. Per capita GDP fell across the region. Inflation, in some countries, reached hyperinflationary levels. Bolivia hit 50,000% annually in 1985. Poverty rates rose sharply. The social costs of the adjustment were borne primarily by the poor. The political costs were equally severe. Democratic transitions in Argentina and Brazil occurred against a backdrop of economic crisis. Governments that promised recovery and delivered austerity fell. The capacity of democratic institutions to manage economic shocks was tested severely. The initial approach, extend and pretend, sought to prevent defaults by rolling over existing debts with new loans. The logic was that a liquidity crisis, not a solvency crisis, was the problem. If banks kept lending and countries kept paying, the crisis would resolve. This logic proved wrong. The Baker Plan of 1985 acknowledged that growth, not just austerity, was needed. It called for $15 billion in new commercial bank lending and structural reforms. The commercial banks, recognizing the loans as non-performing, were unwilling to extend further credit. The plan failed to mobilize the financing it promised. The Brady Plan of 1989, named for Treasury Secretary Nicholas Brady, was the turning point. It acknowledged that the debt burden was too large to be repaid in full. Countries would exchange existing bank loans for Brady bonds, securities backed by U.S. Treasury zero-coupon bonds that guaranteed repayment of principal, with partial forgiveness of the outstanding debt. Brady bonds achieved what extend and pretend could not. They reduced the face value of the debt to a sustainable level while giving creditors tradable securities. Banks could book a loss, move the asset off their balance sheets, and stop being exposed to the indebted countries. The secondary market for developing country debt was born. Mexico's Brady deal in 1990 was followed by Venezuela, Costa Rica, Argentina, Brazil, and others. The crisis formally ended through debt restructuring, not repayment. Latin America's lost decade resulted in a per capita income loss of roughly 8% across the region between 1980 and 1990. Poverty rates rose from about 40% to nearly 50%. The human cost of the crisis, measured in health outcomes, education, and child mortality, was severe and persistent. The Brady Plan enabled recovery. Once debt was restructured to sustainable levels, capital flows returned, domestic investment recovered, and growth resumed. The mechanism was debt relief, not structural adjustment. This lesson, that sovereign debt crises require restructuring, not just rescheduling, became central to subsequent IMF doctrine. The crisis reshaped development economics. The Washington Consensus, the package of liberalization, privatization, and fiscal discipline, emerged from the 1980s as the standard prescription for developing economies. Its subsequent failures in the 1990s would generate the post-Washington Consensus debate. The Brady Plan's innovation, converting illiquid bank loans into tradable bonds, created the emerging market bond market. It also created moral hazard. If sovereign debts would eventually be restructured rather than repaid in full, the incentive for prudent borrowing was reduced. This tension between debt relief and moral hazard remains unresolved in international finance. The debt restructuring that resolved the Latin American crisis drew directly on the intellectual legacy of Volcker's Inflation Shock, Episode 6. The same Fed tightening that broke inflation in 1982 created the interest rate environment that made the crisis possible in the first place. Central bank credibility has costs as well as benefits. The patterns repeat. The faces change. The cost is always borne by those who had no say. Economic Crisis Explained. 2026.